Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today, the hawk and the contrarian go head-to-head on. This relief rally is a trap. Oil at $104 proves it. Let's get into it.
Let me be blunt, this relief rally is a trap. The S&P bounced 1.1% and suddenly everyone's acting like the correction is over. We're still 8.4% below the year high, the Nasdaq is down 11.2% from its peak, and crude oil at $104 is screaming that inflation is about to get worse.
And that's exactly why you should be buying. The VIX is above 30 for the sixth straight session. Since 1990, buying the S&P when the VIX first crosses 30 has delivered positive 12-month returns 88% of the time. You're selling into a historically proven buy signal.
Historical averages are great until the macro regime changes. Oil didn't go from $78 to $104 in 15 days during most of those VIX spikes. That's a 34% move in crude. That's not noise, that's a supply shock.
And markets have already priced it in. Energy stocks are up, airlines are down, consumer discretionary got hammered. The damage is done. When oil spiked in 2022, the market bottomed while crude was still elevated.
But in 2022 the Fed hadn't already cut rates and then had to reverse course. The 2-year yield is sitting at levels that say the market has completely repriced rate cut expectations. The Fed is trapped, they can't cut into $104 oil without losing all credibility on inflation.
The Fed has more room than bears admit. Core PCE is still trending down even with energy elevated. Powell can hold steady and let the data come in. He doesn't need to cut, he just needs to not hike. And nobody serious is pricing in a hike.
Nobody was pricing in $104 oil 3 weeks ago either. That's my point, the consensus is always behind the curve. And look at breadth, 74 stocks in the S&P 500 are trading below their 200-day moving average. That's not a healthy market taking a breather.
That's a washout. When you get that kind of breadth deterioration on elevated VIX, it means weak hands have already sold. The quarter-end rebalancing is masking real institutional buying underneath this move.
Or the quarter-end rebalancing is the move, and once pension funds finish their window dressing, the buying dries up tomorrow. You're attributing conviction to what might just be mechanical flows.
Fair point on the mechanics. But even if you strip out rebalancing, you've got put-call ratios at extremes, retail sentiment surveys at bearish levels we haven't seen since October 2023. That's classic contrarian setup.
Sentiment can stay bearish for a reason. Look at the April gauntlet coming, tariff deadlines, earnings season with companies that have to guide into a $104 oil environment, and a Fed that's going to sound hawkish because they have no other choice.
Earnings season is actually my strongest argument. Companies have been sandbagging guidance all quarter because of tariff uncertainty. When the actual numbers come in better than these depressed expectations, you get a relief move higher.
Better than lowered expectations isn't the same as good. If margins are compressing because input costs just jumped 34% in 2 weeks, beating a lowered bar doesn't fix the fundamental problem.
Not every company runs on crude oil. Tech margins are fine. Healthcare margins are fine. The market is 30% technology, you're extrapolating an energy shock across the entire index.
Energy costs flow through everything: transportation, packaging, manufacturing. And tech isn't immune either. The Nasdaq is 11.2% off its high. If tech margins were fine, we wouldn't be having this conversation.
The Nasdaq sell-off was driven by multiple compression on tariff fears, not earnings deterioration. Big tech is still growing revenue double digits. You're confusing a valuation reset with a fundamental breakdown.
I'll give you that the megacaps are still growing. But look at the Russell 2000, down 10.5% from its highs. Small caps are the canary, and they're telling you the real economy is under stress. These are the companies that can't hedge oil exposure or absorb tariff costs.
And IWM jumped 1.5% today, the biggest bounce of the 3 indices. When small caps lead a rally off a washout low, that's historically been the strongest signal that the bottom is in. Money is rotating into the most beaten down names.
One day. It's one day. The 2018 tariff sell-off had 3 separate relief rallies of 1 to 2% before rolling over to new lows. The 2020 COVID crash had a 9% bounce before dropping another 25%. Dead cat bounces look exactly like this.
And in both cases, buying within the elevated VIX window, not trying to time the exact bottom, produced strong returns within 12 months. You don't need to catch the bottom. You need to be positioned for the overshoot when the fear clears.
Sure, if you can stomach another 10 to 15% drawdown while waiting for that 12-month return. Most people can't, and that's why the historical stat is misleading. The path matters, not just the destination.
Now you're making an emotional argument, not a market argument. If the data says 88% win rate over 12 months, the correct response is to size your position so you can handle the path. That's risk management, not a reason to sell.
It's not emotional to point out that commodities are pricing in a completely different reality than equities. The bond market and the oil market are both flashing warning signs. Equities are the last to figure it out, they always are.
Or equities are correctly pricing in that this oil spike is temporary and the tariff situation gets walked back, like it did in 2018 and 2019. Markets are forward-looking, bonds and commodities are reacting to right now.
We'll see in April. When the tariff deadlines hit, when earnings guidance reflects $104 crude, and when the Fed reminds everyone they're not coming to the rescue, this bounce will look like the gift the bears were waiting for.
And when the VIX collapses back below 20, when positioning unwinds, and when everyone who sold into this panic realizes they got shaken out at the low, this conversation will look very different. The panic is priced in. The recovery isn't. The hawk, the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.